When you hear the word liquidity in trading, what is the first thing that comes to your mind? For many traders, liquidity sounds like a complex concept used only by professional institutions. But the truth is simple. Liquidity is the fuel that moves the market. Without liquidity, the market cannot move. In this lesson, you are going to learn what liquidity really is and how large institutions manipulate it to move price in their favor. Once you understand this principle, you will begin to see the market differently. You will stop trading like the crowd and start thinking like the smart money. Let me explain liquidity using a very simple example. Imagine a marketplace where oranges are being sold. If there are many sellers of oranges but only a few buyers, what will happen? Naturally, the price of oranges will drop because supply is high and demand is low. In trading terms, this situation represents a supply zone on the chart. There is too much supply and not enough demand. Because sellers dominate the market, the chart will start forming a bearish market structure. A lower high, a lower low, another lower high, and another lower low. This simply shows that sellers are controlling the market. However, even in a bearish market, there will still be a few buyers trying to enter trades. These buyers may create small upward movements such as a higher low, a higher high, but because their capital is small compared to institutional money, their impact on the market is limited. Now think about what happens around the lower high in this structure. Most retail traders who are selling will place their stop loss above that lower high. At the same time, some buyers will also place their buy stop orders around that same level. Because price is moving within a tight range, many orders begin to accumulate there. Stop losses, pending orders, entry positions. When many orders gather in one area, that area becomes what we call a pool of liquidity. Now this is where the big players enter the game. Institutions are not interested in trading in places where there are few orders. They need large amounts of liquidity to execute their positions. So when they notice a liquidity pool, they become interested in that market. But here is the key thing most traders do not understand. Institutions will not sell where everyone else is already selling in the supply zone. Instead, they will often buy into the selling pressure. Because they have huge capital, they can absorb all the selling orders and trigger the stop losses sitting above the structure. Once those stop losses are triggered, something important happens. Liquidity is released into the market. This sudden liquidity allows institutions to push price aggressively. Price will then break the market structure and move strongly upward into a new demand zone, creating higher prices. Now that price is higher, many traders begin to notice the move. Suddenly, everyone wants to buy the oranges, even though the price is now higher. This creates a new structure such as higher highs, higher lows. But once again, traders begin placing stop losses, buy orders, sell orders. Another liquidity pool forms at these higher prices. And then something interesting happens. Once enough liquidity has accumulated, institutions may suddenly reverse the market. They begin selling heavily at the higher price, pushing the market sharply downward. Because they entered at better positions and used the liquidity from the crowd, they are able to make massive profits before quietly exiting the market. This is the hidden principle behind liquidity in financial markets. If you want to truly master trading, you must learn how to identify liquidity in real time and position yourself around it. So make sure you follow this page and continue learning with me. And don't miss my next videos where I will show you how liquidity appears directly on real charts and how you can trade it step by step for high probability setups. Because once you understand liquidity, the market will never look the same again.